Asian markets got pummeled in today's session, a combination of tensions between the US and Russia, the US and Saudi Arabia, and the usual trade face-off with China have served to undermine any positive sentiment. And it looks like the Asian markets have set a trend for global markets today. Tokyo stocks got hit hard with the Nikkei share average down 2.7%. Hong Kong stocks proved the weakest link with the Hang Seng index tumbling 3.1%. Mainland China stocks declined, but not to the same extent. The Shanghai Composite Index falling 2.3%. Over the United States, the S&P 500 and Dow slipped in choppy trading on Monday following losses in energy and financial stocks, and as caution grew ahead of a slew of earnings this week. The Dow Jones Industrial Average fell 0.5%, the S&P 500 lost 0.43%, and the Nasdaq Composite added 0.26%. Well, it's a risk-off day, Markets across the world are blazing red. The local all-share index has suffered losses close to 2%, while the local currency has also lost ground, down around 0.5% against the US dollar. With the risk-off tone, precious metals like gold and platinum are having a great day, with the gold price up as much as 1.7% during today's session. A slight plus for oil importing countries like South Africa is that Brent crude oil continues a downward trend, but of course this could be short-lived. And of course, as I mentioned, the local currency is on a weak trend today. Let's take a look at the indicators. Well, for more on the markets, I'm joined by analyst Chris Gilmore. He joins us from our JSC studios right now. Thanks very much for joining us, Chris. Is it an exaggeration to say that there's carnage on the markets today? And just explain why we're seeing so much red.
Yes, hi there, Nompu. It's not an exaggeration at all. No, far from it. It really is carnage, and I think it's going to continue for quite some time. Traditionally, September and October have been very volatile months, going back many, many decades, and this is no exception. But I think what's happening here is this is all being driven by what's going on in the US, and with other peripheral events as well, but predominantly the US. So, for example, I got wind of this a few weeks ago, when I looked at a thing called the Bloomberg Smart Money Flow Index. And really what that charts is money that is what they call smart money. And they look at the first half hour of trade and the last hour of trade to try and take out the noise on the Dow Jones or the S&P, the New York Stock Exchange, and try and divorce the real action from kind of speculative action. And they chart that at Bloomberg. And what that has shown is that there's a big divergence from the actual markets being going up like that, and the smart money flow index has been going like that. So in other words, what they're saying is the smart money, the really clever money, has been getting out of the market for about the past 6 months. Now, coupled with that, you've also got a situation where what are called corporate insiders in the US, people who have access to information about their own companies, and they've been selling their own shares in the companies. And at the same time, because they've got the latitude to be able to buy shares in their own company on behalf of the company, they've been buying shares, helped along by the tax relief that they've got from lower tax rates in the US thanks to President Trump. So, in other words, they're pushing up the value of their shares and selling into that strength. And I think that's becoming more and more obvious now as time goes on. So yes, you're getting fairly strong earnings growth coming out of the companies, but that's not going into productive means of production. That is going really into share buybacks and things like that. It's artificially keeping the market up, and a lot of people are selling into that strength. So what happens in the US is followed not long thereafter by the action on other global markets. So I think we're in a very precarious time at this particular juncture. And I think that's why I say you're right, it's carnage, and I think it's going to go on for a while yet, because fundamentally the market's at very, very high levels. This is the longest bull market we've ever had. And it's probably time for a correction.
Is it a fallacy for us to be talking about global growth when it seems as though the only economy that seems to be growing is the United States?
Yeah, it's funny how many commentators no longer refer to synchronized global growth anymore. They've stopped talking about that in the past few months. So yes, you're quite right. The US is growing, but you only have to scratch the surface to see that a lot of that growth is superficial. Where are the manufacturing jobs that are being created? The housing market isn't looking so wonderful these days. Yes, and they're creating a lot of barista jobs behind coffee bars and stuff like that. But really fundamental growth in the US isn't that wonderful. Yes, the unemployment rate has come down significantly to almost residual levels, and that's seen as being a good sign, a strong sign. But at some point in time, the US economy is going to peak, and more economists are of the view that that'll probably be in 2019 or 2020 at the latest. So, again, if you're trying to correlate what's happening in the market with the underlying strength of the economy, again, markets anticipate what's going to happen. And I think it's likely that, again, that this underlines my view, endorses that view, I think, that markets are precarious and will start to come off in the not too distant future.
So if we look at what's happening today, carnage on the market, what has it meant for emerging markets like South Africa, especially our currencies? And going forward, if the US economy does peak, as you say, and we see stocks, tumble as a result, what will the implications be for emerging markets then?
That's a very interesting and a very important question, Nompu. As far as South Africa specifically is concerned, it is decoupled, and I hate to use that expression, but it's about the best word I can think of at this point in time. But it's decoupled from the growth that we've seen in the US market. So while the US markets have gone upwards trajectory, we've kind of come down. If you look at what's happened to the JSE All-Share market, JSE All-Share Index, should I say, since the height of Ramaphoria back on the 25th of January, when it hit something like 63,500, I think was the figure, it's dropped by about 15%. Well, that was when I did my calculations a couple of days ago. So it's come down a couple of percent more than that. So we're probably down at about 17% down. Now, most observers will say to you that anything above 10% is called a correction. If it gets beyond 20%, that is a bear market. So we're perilously close to bear market territory in rand terms. Now, if you convert our market into dollar terms, the decline, we're already well into bear market territory. So it's really not looking good. And I think most emerging market countries are in pretty much the same boat. So I think it comes back to what you were saying right at the very beginning of the show. This is a risk-off situation. In other words, investors and speculators alike are not prepared to get into riskier ventures or perceived riskier areas like emerging economies. And then I think to answer your question is, if on top of that, all of that, if you overlay a situation where the US takes a bit of a big tumble and drops 10 or 15% from these levels, then I think undoubtedly emerging markets will get caught up in that maelstrom, and it will just get worse and worse and worse. I don't think you can take the view, I don't think you can draw any comfort from the fact that we've fallen so far already. If the US takes a big kicking, we'll get a further kicking, to put it bluntly.
And very quickly, Chris, before I let you go, tomorrow is the midterm budget policy statement. Your expectations?
I don't have great expectations out of this at all, because I really feel for Tito Mboweni, because his hands are largely tied. There's not an awful lot he can do. But I think what he has to do is to demonstrate what his predecessor Nhlanhla Nene was trying to do, to actually get a reduction in government spending. And Nene was very, very vocal about this, and all power to his elbow. He really was. He was very, very good. And I think if Tito can carry on along in those lines, and he's already put out a few feelers talking about reducing government expenditure on people. Difficult path to follow, but I think if he can stick to that line, if he can really stick to this whole bit about fiscal consolidation, then he'll have achieved quite a lot.
All right, we'll watch that space. Thanks very much, Chris Gilmore. He's an independent analyst just giving us his assessment of what's happening on the markets. More business news for you after a short break.